Hey everybody, welcome to Java Jabber Live. I am your host, Rob Sassos. Java Jabber Live is where we talk about the news that's not necessarily on the news, but newsworthy nonetheless. Like I said, I'm your host, Rob Sassos. I am a real estate broker, thus we have a real estate twist on the news. I specialize in residential real estate property management in the Central Florida area. Some sweet spots of mine are Winter Park, downtown Orlando. Windermere, the community of Bay Hill, where I am the preferred real estate broker. And happy to assist you in any way I can, but I also service all of Central Florida, as does my team of amazing realtors. I'm also a member of the Orlando Regional Realtors Association's Governmental Affairs Committee, Communications Committee, Podcast Subcommittee, and local liaison for the City of Winter Park. If you have any questions about buying or selling or property management, I am your dude. Rob at simplicityre.com. I'll be happy to answer any questions that you have. Go check out my website, simplicityre.com as well. All right, so let's talk about some news for Thursday. We're doing Thursday over because for whatever reason, Facebook didn't like my Thursday recording. So we're doing Thursday on a Friday, but it happens every Tuesday and Thursday whenever I'm awake. The coffee is ready and the computer behaves. So we've got mortgage rates drop again. ARMs, buyer loan options tainted by the Great Recession. What are the most fun states in the U.S.? Florida focus. 1 out of every 7 out-of-state moves. New use proposed for Old Winter Park Library and new cheese shop opening in Winter Park. Smells delicious. All right, so mortgage rates drop again this week to 5.3%. Recession fears pushed the 30-year fixed-rate mortgage down from last week's 5.7%, though they remain higher than the 2.9% recorded last year at this time. Average long-term U.S. mortgage rates eased again this week as the Federal Reserve remains likely to raise its benchmark borrowing rate in its ongoing battle to bring down inflation. Mortgage buyer Freddie Mac reported Thursday that the 30-year rate fell to 5.3% from 5.7% last week. 1 year ago, the average 30-year rate was 2.9%. The average rate on a 15-year fixed-rate mortgage, popular among those refinancing their homes, fell to 4.45% from 4.83% last week. A year ago, that rate was 2.26%. The Federal Reserve raised its benchmark rate last month by 0.75 of a point, the biggest single hike since 1994. In notes from its meeting released Wednesday, Fed policymakers signaled that much higher interest rates could be needed to rein in 4-decade high inflation. They also acknowledged that their rate hikes could weaken the economy, but suggested that such steps were necessary to slow price increases back to the Fed's 2% annual target. The Fed's unusually large rate hike came after government data showed U.S. inflation rose in May to a 4-decade high of 8.6%. The Fed's benchmark short-term rate, which affects many customers and business loans, will now be pegged to the range of 1.5 to 1.75%, and Fed policymakers forecast a doubling of that range by year's end. Higher borrowing rates have discouraged house hunters and chilled the housing market, one of the most important sectors of the economy. Sales of previously occupied U.S. homes slowed for the 4th consecutive month in May. Home prices kept climbing in May even as sales slowed. The national median home price jumped 14.8% in May from a year earlier to $407,600, an all-time high according to the National Association of Realtors. Data ongoing back to 1999. The mortgage applications have declined 17% from last year and refinancings are down 78%. The Mortgage Bankers Association reported this week those numbers are unlikely to improve much with more Fed rate increases a near certainty. Layoffs in housing and lending sectors have already begun. Last month, the online real estate broker Redfin said it was laying off 8% of its workers, and Compass said it was letting go of 450 employees. The nation's largest bank by assets, J.P. Morgan Chase, is laying off hundreds from its mortgage unit and has reassigned hundreds for other jobs elsewhere in the firm. So for the price values and things like that, how they said the price increase is still gone up. And it might for the next month or so, and then you'll start seeing it flatline. It usually takes it a minute for it to catch up to the rates. in terms of appreciation, and then sellers coming to the reality of the good times are over and we need to adjust our pricing accordingly. I just had some sellers that I'm working with wanted to know if they waited towards the end of the year, if that would impact the value of their home. And it didn't necessarily say it will impact the value of their home in terms of rising appreciation of homes over the last 2 years. I think it's been over 13% actually. Yeah, that's going to slow. So your appreciation is not going to be the same. Will you lose value in your home? Potentially not. Also depends on location, a lot of other market factors as well. But you're not going to see that dramatic price increase if you were hoping to get that one more year. You'll also see, or you should see, more homes inventory on the market come spring of next year, beginning of next year as well. As the market slows, so does the inventory reductions. So you should see those starting to come back to normal, in my opinion. If you have any other questions about real estate, rob@simplicityre.com, or message me anywhere you see this post, or vlog, or video, or whatever those crazy kids are calling it nowadays. ARMs, buyer loan option tainted by the Great Recession. Zero down, interest-only adjustable rate mortgages played a role in the last recession, but today's options are safe if buyers understand the pros and the cons. A fixed-rate mortgage, FRM, holds the same interest rate for the life of the loan. An adjustable rate mortgage, ARM or ARM, generally offers a fixed rate for a limited period of time, often 5 to 7 years. After that, the ARM's interest rate and corresponding homeowner's monthly payment can rise or fall depending on the market. The benefit to an ARM, the buyer gets a lower interest rate. Lenders offer a lower interest rate because the borrower has given them permission to increase their future interest rate. However, rates could also go down. Still, any interest rate prediction 3, 5, or 7 months in the future has an inherent risk for the buyer. The details of ARMs can vary, and buyers should fully understand each one's risk and rewards. Generally, for example, an ARM that can adjust in 3 years will carry a lower interest rate than one that can adjust for the first 7 years, but the latter may give a buyer more peace of mind than the former. Common types of ARMs, according to the Department of Housing and Urban Development: a 3-year ARM may increase by 1 percentage point annually after the initial fixed interest rate period, those 3 years, and a maximum of 5 percentage points over the life of the mortgage. A 5-year ARM may allow for increases of 1 percentage point annually and 5 percentage points over the life of the mortgage, or it may allow increases of 2 percentage points annually and 6 points over the life of the mortgage. A 7 and 10-year ARM may only increase by 2 percentage points annually after the initial fixed interest rate period and 6 percentage points over the life of the mortgage. A growing number of buyers in today's select ARMs, if FRM rates have priced them out of their dream home, but an ARM can also, that's a bad sentence, but an ARM can also be a good option for buyers who only plan to live in a home for a few years, or ones who expect higher future earnings. ARM's components. An ARM has 4 components: index, margin, interest rate, cap structure, initial interest rate period. When the initial interest rate period expires, a new interest rate is calculated by adding a margin to the index, such as the 2 percentage points above a specific financial rate, published in the Wall Street Journal. 1-year London Interbank, posted in the Wall Street Journal. For example, Federal Housing Administration FHA loans may use indexes such as the Constant Maturity Treasury (CMT) Index, weekly average yield of U.S. Treasury securities adjusted to a constant maturity of 1 year, or the 1-year London Interbank Offered Rate, or LIBOR. Increases or decreases in the interest rate will be limited by the interest rate cap structure of the loan. A lender discloses the margin at the time of the loan applications, and margins may vary from lender to lender. So buyers should shop around. FHA offers a standard 1-year ARM and 4 hybrid ARM products. Hybrid ARMs offer an initial interest rate that is constant for the first 3, 5, 7, or 10 years. After the initial period, the interest rate adjusts annually. The interest rate cap provides some protection for buyers if the market sees a large rate increase. There are 2 types of caps: annual and life of the loan. An annual cap, this restricts the amount of interest rate can change up or down in any given year. If the annual cap is 2%, for example, and U.S. interest rates have risen 4% since the last adjustment, homeowners' rates can be raised by that full 4%. Life of the loan or can't be raised by that full 4%. They can be raised by the 2%. Whew, need my glasses. Life of the loan cap. This limits the maximum and minimum interest rate for a homeowner and what they'll be expected to pay as long as they have the mortgage. If the life of the loan cap is 5% and interest rates 20 years down the road have gone up 10% since they took out the loan, for example, their increase is still limited to the maximum 5%. So there's everything you wanted to know about ARMs. If you'd like more information on that or go over this information again, I'll be happy to assist. You really need to understand them and have a strategy for them. There's specific strategies where these would be of benefit, but this is definitely not one shoe fits all type thing. You really need to know what you're getting into when you're working with ARMs. Rob at simplicityre.com. Most fun states in the U.S. Florida ranks as number 2. What? We should be number 1. Why should someone move to Florida? Because it's officially fun, according to the Wallet Hub study that looked at entertainment, recreation, and nightlife. A Wallet Hub study sought to gauge how fun states are by evaluating 65 metrics across 3 categories: entertainment and recreation, nightlife, and parties, and overall costs. Florida was found to be the nation's second most fun state to visit behind California. How is that possible if you factor in cost? I think it costs like $20 just to look at a cheeseburger in California. The study cited Florida's wide range of leisure options and its second highest number of restaurants per capita. Florida also has numerous performing arts sites, golf courses. There's golf courses in Florida? Country clubs, fitness centers, and the most marinas, according to the study. Rounding out the top 10 most fun states were Nevada, New York, Illinois, Colorado, Washington, Texas, Minnesota, and Louisiana. Most fun states were Nevada, let's be honest. Most fun part of the state would be Las Vegas. So there you go. We're number 2. Florida focus of 1 out of every 7 out-of-state moves. More Americans dream of moving to Florida than other states, according to Coldwell Banker, and a high percentage of Florida residents won't search for a home elsewhere. According to Coldwell Banker's Move Meter, cool, I don't have that. A tool designed to show Americans moving goals, Florida is not only a top destination searched by out-of-staters, but few Floridians looking for a new home gaze beyond the state's borders. Over 82% of all Move Meter searches to date were looking to move out of state. The average Move Meter search covered 1,015 average miles. 82% of the searches were for a move out of state. Massachusetts has the greatest proportion of searchers considering staying in-state, with 40% of all searches from Massachusetts looking to stay loyal to the Commonwealth. About 13% of all searchers looked within driving distance of 100 miles from their original destination. The highest proportion of moves being considered was somewhere between 500 to 1,500 miles at 42%. Midwesterners and Northeasterners are looking for warmer temps in the Southeast. Southeasterners and Southwesterners and Westerners all had higher likelihoods of staying local to their respective regions. Where to move, the number 1 state topping the Move Meter was Florida, with 1 out of 7 of all Move Meter searches looking to move to the Sunshine State. The top states looking to soak up the Florida sun included New Jersey, California, New York, Illinois, Ohio, and Massachusetts. The Florida cities that held the most interest: Sarasota, Miami, Naples, my hometown, and Tampa. Floridians also see the state's appeal, and it's one of the top states for residents searching for other metro areas within their home state. The other top states Floridians searched were North Carolina and Tennessee. Austin, Texas was the most searched destination to move to, with 6% more searches than the next closest destination. We can say it, destination. The top locale dreaming about moving to Austin is San Diego, California. Interesting. 20% of searches from California were looking to stay in the Golden State. The top in-state searches looking to move somewhere else within California were from San Diego, San Francisco, and Bakersfield. For Californians considering an out-of-state move, the top destinations were Texas, Florida, Tennessee, Washington. Overall, with the top metro areas of interest, Austin, Dallas, and Seattle. Destination dreams, the top 10 search cities included Austin, Sarasota, Florida. So boring. San Diego, Denver, Nashville, Tennessee, Tampa, Florida, New York, Naples, Florida, Charlotte, North Carolina, and Seattle. Naples, Florida. Wow. Little bitty place. Getting all that attention. There's not enough room for all you in Naples. Go home. Anyway, so there you go. 1 out of every 7 is looking to move from the move meter to Florida. So we've got that brand new Winter Park library / civic center / whatever it is. So what are we going to do with the old Winter Park library? Well, let's see here. A roughly $10.5 million redevelopment effort to add co-working office space, a cafe serving healthy options and health wellness service to the former Winter Park Library is pending approval by the city leaders. The city has been seeking a new use for its old library space since it closed in the heart of downtown in early 2021. The private sector was invited to submit proposals this year for the empty 35,000 square foot space. The lone bid came from a team consisting of Herbert Realty Services, which we talked about earlier. They go on to say, so often we kill ideas and projects because we're looking for the perfect fit. He said, this is not a perfect in my mind, but I think it's very good. If we try to push for a perfect fit, I just keep saying perfect, we may still be sitting on this property 5 years from now, just like it is, with nobody in there, with it getting more and more dilapidated, and with the city throwing money at it year after year just to keep it viable. So I think this is worth continuing a talk. Ultimately, the city commission, and who said that? That was city manager Randy Knight. Ultimately, the city commission will have the final say on whether the building is to be leased out to the bidders. The city did not provide information about how the lease arrangement would be structured under the current proposal. Per state statute, bids are exempt from state's public record laws for at least 30 days. Following the closure of the solicitation period, the bidding closed on June 6th. So there you go. Looking to multi-purpose it, multi-use it, put in a healthy food cafe. Okay, but they're going to have to redesign the look because it just looks like a big piece of brick with some little windows at the top. So hopefully they redesign the whole thing. And then finally, something cheesy. New cheese shop opening in Winter Park. A new self-described one-stop shop for cheese lovers will be opening this month in Winter Park, led by Midwest-raised cheese enthusiasts. We're just raised differently in the Midwest. If we had a family gathering and we didn't have a cheese ball, something wasn't right. I just love cheese, and I feel like there are a lot of people like me who like a place to go, taste and sample cheeses before they buy it. We want it to be a cheese lover's dream, a true multi-sensory experience for them. Ann Thornton, owner. Well, she must be in Wisconsin or Illinois or somewhere there, because I'm originally from Ohio, and I never got disappointed if there was not a cheese ball at the family table. But I do love cheese. Simply Cheese, owned by Grand Rapids, Michigan. Oh, Michigan. Well, that explains it. That state up north. Is located on 2258 Aloma Avenue in Winter Park and is scheduled to open to the public later this month. The new store will feature farmhouse-inspired decor and offer 60 different varieties of cheese that have been hand-selected from around the world, and they will offer cut-from-the-wheel cheeses that customers can sample prior to purchasing or taking home a snack pack of samples to enjoy. The shop will also carry charcuterie, I can say it, accompaniments like prepackaged meats, spreads, jams, honeys, and even vegan options. The shop will also carry goods from local Florida and Michigan-based makers, breweries, and wineries. Stick to Florida, not that state up north. A grand opening is scheduled for Saturday, July 23rd, with a farmers market-like celebration where guests can taste and shop from 9 a.m. to 4 p.m. Go check them out. The new cheese shop. Simply Cheese. Well, that is a Java Jabber for a Thursday, or end of week, we shall say. I hope you like it. If you did, please like and share. Local business owner, small business owner, all the help's truly appreciated. If you have any questions about buying or selling real estate or property management, I'm your guy, Rob at simplicityre.com. Go check out my website if you want to know the value of your home or any home in the Central Florida area. I have an app for that right on the site. Go check it out. It's a home valuation calculator in the selling section or on the front page. Enter the address of the property. I ask you a couple pull-down questions. Takes you about 30 seconds, and boom, give you an estimated value of the home. Any other questions, let me know. Oh, and if you mention you heard me on Java Jabber, or saw me on Java Jabber for that matter, and you're interested in property management, I will take 2% off our monthly property management fee Reasonable and customary is 10%, so you do the math. Other than that, y'all have a great weekend. See you next Tuesday. And be safe out there. Bye for now.